Hi everyone, today we'll be going over accounts October-November 2020 paper 3 question number 1. This is structured paper 3 which consists 6 questions each of 25 marks and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes and this question number 1 is a part of section A which deals with financial accounting. Now without any further delay, let's get started. GH prepared draft financial statements for the year ended 30 June 2020. These included the following. So we're given the draft income statement, which consists of revenue, cost of sales, gross profit, distribution costs, administrative expenses, profit from operations, finance costs, and finally our draft profit for the year. Then we're given additional information. We're given lots of additional information. All right, let's have a look at our first question. For the first part, we need to calculate the correct value of inventory at 30 June 2020. So this is essentially asking us to figure out the value of our closing inventory. Okay, let's have a look above. We are only given cost of sales, so we're not given the value of our closing inventory explicitly in our draft income statement. So let's have a look at our additional informations. The draft cost of sales value comprised opening inventory of 85,000, purchases of 1,317,000, and closing inventory of 78,000. So our draft closing inventory is 78,000. So we will start with this draft value of our closing inventory in order to figure out its correct value. Let's write it down. Okay, we can prepare a statement and we will be starting with our draft closing inventory, which had the value of 78,000. Let's have a look above. Then for the second information, we are told that included in sales were goods which had been invoiced to a customer on a sale or return basis. So whenever we're talking about sales made on a sale or return basis, that value should not be included in revenue, right? And these goods had the original cost of 8,000 and a selling price of 20,000. So like I said before, our revenue should not be including this 20,000. So I'm just going to write it here that this 20,000 should be subtracted. And if we are subtracting its value from the revenue, then we definitely need to add back its value to our closing inventory, right? Since the customer has not yet decided to make a purchase. And we know that in our inventory, we only include the cost. And we're given that the original cost was of 8,000. So we just have to add this 8,000 back into our closing inventory. Let's do that. So we're just going to add our sale or return basis, which had the cost of 8,000. Okay, let's have a look above. Then for the third information, we are told that included in closing inventory were goods which had originally cost 27,000 and had a normal selling price of 63,000. These had been damaged. So whenever the goods are damaged, its original cost should be subtracted from the closing inventory. So let's subtract the original cost of 27,000 as it has been damaged. So that's less damaged goods. And this had the original cost of 27,000, so we're just going to subtract it. Okay, let's continue with that particular information. Then, and now only be sold. So it can be sold, but only for 18,200, whereas previously its selling price was of 63,000. After repairs costing 4,100 had taken place. So whenever we're talking about damaged goods which could be sold again after repairs, its value should definitely be included because this is a good which can be sold, but its cost has obviously been altered. So now new cost to be included in our closing inventory value would be that of its selling price, which is the value that this good now could be sold for, minus our all of the repairs cost. So we know that this now could be sold for 18,200, but after a repairs costing of 4,100. So we just need to subtract that repair cost. So now the new cost to be included in our closing inventory would be that of 18,200 minus 4,100, which gives us the value of 14,100. Let's include this value in our closing inventory. So let's add damaged goods and this had the value of 14,100. Let's have a look above. For the fourth information, we're told that import duties of 30,000 on goods purchased for resale had been included in distribution cost. But we can see that this import duty does not fall under distribution or selling costs, right? Because this is essentially a cost associated with goods purchased, which means that this can be termed as carriage inwards, which should be included in our cost of goods sold. So it should definitely not be included in the distribution cost. So we just need to subtract this value of 30,000 from our distribution costs. So I'm just going to write it here, minus 30,000. And this import duties should be actually included in our cost of goods sold because this is the cost associated with goods purchased. And we're also told that of these, 3,500 related to goods in inventory at the end of the year, meaning that 3,500 are associated with our closing inventory. So this value should definitely be included in our closing inventory as well. Let's add it. So let's add import duties. And the amount associated with closing inventory was only 3,500. All right. Then we're given export duties of 7,200 had been included in administrative expenses in the draft income statement. But these are export duties, meaning that this is associated with our selling costs or distribution costs. So this should be included in distribution costs rather than our administrative expenses. So I'm just going to include it right here. The 7,200 should be included in our distribution costs rather than the administrative expenses. Okay. Then we're told that the value of trade receivables, so this is definitely not associated with closing inventory. We can just skip it for now. Then we're given other income, which is again not associated with closing inventory. Then we're told that during the year ended 30 June 2020, a customer had started a legal action. So this definitely does not concern closing inventory again. So we can just skip it for now. Then we're given impairment loss. So impairment loss definitely does not fall under the closing inventory section, which means that we have included everything that we needed to in order to figure out our correct value of closing inventory. So let's figure out the correct value. So that's inventory at 30 June 2020. And that is just going to be the sum of these five amounts. So that's 78,000 plus 8,000 minus 27,000 plus 14,100 plus 3,500, which results in the value of 76,600. And this concludes the first part. Now for the second part, we need to figure out the cost of sales for the year ended 30 June 2020. Okay, we can again prepare our statement. So we definitely start with the opening inventory. Then we add all of our purchases. Then we add our carriage inwards, which in this question is termed as import duties. And then we subtract our closing inventory. And this gives our cost of sales. Okay, let's figure out the values. So we were told that the opening inventory was of 85,000 and there are no changes to be made in our opening inventory considering all of these informations, right? So we can just substitute this value of 85,000 into our statement. So that's 85,000. Then we need to include our purchases. And we were given the purchases value of 1,317,000. And again, no adjustments were to be made considering all of our information. So we can just substitute this value. So that's 1,317,000. Then we had our import duties. And import duties was of 30,000. So we just need to substitute this value. That's 30,000. And finally, we need to subtract our closing inventory, which we figured out above, which had the value of 76,600. So that's 76,600, and we need to subtract this. Now we can easily figure out the value for cost of sales. That's just going to be the sum of these four values, which is 85,000 plus 1,317,000 plus 30,000 minus 76,600, which results in the value of 1,355,400. This is the value for our cost of sales for the year ended 30 June 2020. So this concludes the first part of this question. Now we can move towards the second one. Now we need to prepare a corrected income statement for the year ended 30 June 2020. And we are figuring out our income statement for GH PLC. This is an income statement. And this is for the year ended 30 June 2020. Okay, and whenever we're talking about income statement, we always start with our revenue. So let's figure out the value for revenue. We are already given the value of revenue in our draft income statement, and we figured out that we need to subtract the value of 20,000 because this was included, whereas this sales was actually made on a sale or return basis. So this should definitely not be included in our revenue in the income statement, right? So this gives our new revenue to be included to be 1,980,000 minus 20,000, which results in the value of 1,960,000. So now we just have to substitute this value for revenue in our income statement. Let's do that. We figured out the correct revenue to be 1,960,000. Then the next step would be to subtract our cost of sales, and we already figured out the value for cost of sales in the first part of this question, right? So we can just easily substitute that value. It amounted to 1,355,400. Let's substitute this. That's 1,355,400, and since we need to subtract it, I'm just going to put it in a bracket. Now we can easily figure out the gross profit. And gross profit is just the difference between revenue and sales, which in this case is 1,960,000 minus 1,355,400, which results in the value of 604,600. Okay, after gross profit, the first thing we need to do is add all of our other incomes. So let's have a look at our information. So till fifth information, there were no incomes, right? So we can look towards the sixth one. The value of trade receivables in the draft statement of financial position was 194,000, which was shown after deducting a provision for doubtful debts of 6,000. And this was the provision for the start of the financial year. So this is the value of trade receivables at our year end, which was shown after deducting a provision for doubtful debts of 6,000, which was actually the opening provision for doubtful debts. So that is definitely an error, right? So our trade receivables at our year end before provision for doubtful debts would just be 194,000. And since we figured this value out after subtracting 6,000, which was an error, so now in order to reverse that error, if it was subtracted before, we just need to add that value back. So we need to add the 6,000. Alright, now this gives our trade receivables at the year end to be 200,000. Then this was a provision for the start of the financial year, which needed to be updated to 5% of the closing trade receivables. Okay, so we could have easily multiplied it with the rate of 5%, but we also know that there was sale made on a sale or return basis, and that value was definitely included in our trade receivables, right? Because we included it as our sales. But now, since we know that we cannot include it in sales, we definitely cannot include that value of 20,000 in our trade receivables as well, right? We were given that in our second information right here. These goods had an original cost of 8,000 and a selling price of 20,000. And since this was sales made on a sale or return basis, we definitely did not receive cash. So this was turned into our credit sales, and credit sales are definitely included in our trade receivables. But since we now decided that this should not be included in our sales, then this definitely does not need to be included in credit sales as well, which means that it should definitely not be included in the trade receivables. So we just need to subtract this value of 20,000, which gives our correct trade receivables at the year end to be 200,000 minus 20,000, which gives us a value of 180,000. Alright, so now this is the actual value in which we need to apply our rate of 5%. So let's figure out the provision. That's just going to be the trade receivables value of 180,000 times the rate of provision, which is 5%, which we can write down as 0.05. So this gives our closing provision for doubtful debts to be 180,000 times 5%, which is 9,000. And this is our closing provision, right? And we were told that our opening provision is 6,000. And what we know is that if there is an increase in provision for doubtful debts, that is termed as an expense, and if there is a decrease in provision for doubtful debts, that is treated as an income in our income statement. And we can clearly see that the closing value is definitely greater than the opening value, so there is an increase in our provision for doubtful debts. So I'm just going to write it here: increase in provision for doubtful debts. So that's just the difference between the closing provision and opening provision. We have our closing provision to be 9,000 minus the opening provision of 6,000, which results in the value of 3,000. And since this is an increase, this is an expense. And our provision for doubtful debts is definitely to be included in our administrative expenses. So let's just add this 3,000 to the administrative expenses above. So that's plus 3,000. Okay. Then for the seventh information, we are told that other income of 6,300 had been netted off against administrative expenses. So we should definitely not be doing this. We cannot net off incomes to our administrative expenses. So we need to add this expense back to the administrative expenses and add this income back to our correct income statement now. So I'm just going to mention this 6,300 right here in administrative expenses. And we need to add that amount of 6,300 as other income to our gross profit in the income statement. Let's do that. So that's other income with a value of 6,300. Let's have a look above to see if we have any other incomes. Okay, we are done with seventh information. Then for the eighth one, during the year ended 30 June 2020, a customer had started legal action against GH PLC. At the year end, it was considered that there was a 75% possibility that GH PLC would lose the case and have to pay 31,000. Okay, so we're given a possibility here, right? And we know that if there was a possibility of less than 50,000 of having to pay 31,000, then this would be a contingent liability, which should not be recorded in the income statement, but should be recorded by a note to the accounts. But since we have a possibility higher than 50%, this 31,000 now requires a provision, which lowers the profit, which means that this provision should be treated as an expense in our income statement, right? And this provision is also a liability because we have not paid it yet. So we can say that this 31,000 is an expense to be recorded in our income statement, and this should be included in our administrative expenses. So I'm just going to add the 31,000. Okay. Now for our last information, we are given an impairment loss of 4,000 relating to delivery vehicle was yet to be accounted for. So since we're talking about delivery vehicle, this definitely falls under distribution cost, right? Which means that this impairment loss of 4,000 should also be charged towards our distribution costs. So let's add it. That's plus impairment loss of 4,000, which means that there is no other incomes to be included in the income statement, which means that we now can move towards the overheads, which are the distribution costs and administrative expenses. So let's just write the headings down first. That's less overheads, and we have our distribution cost and administrative expenses. And we have already adjusted, we just need to figure out the total. Alright, for distribution cost, that's going to be 186,500 minus 30,000 plus 7,200 plus 4,000, which results in the value of 167,700. Let's charge this amount to our income statement. That is 167,700. Now let's figure out the total for administrative expenses as well. So the total for administrative expenses is going to be 391,000 minus 7,200 plus 3,000 plus 6,300 plus 31,000, which results in the total of administrative expenses to be 424,100. Let's substitute this value into our income statement. So that's 424,100. Now we can easily figure out the total for overheads. That's just the sum of distribution costs and administrative expenses, which in this case is 167,700 plus 424,100, which results in the total of 591,800. And since this is overheads, we need to subtract this, so I'm just going to record it in a bracket. Now we can easily figure out our profit from operations. And that's going to be gross profit plus other income minus overheads. So that's 604,600 plus 6,300 minus 591,800, which results in our profit from operations to have the value of 19,100. And the next step would be to subtract our finance charges. Let's have a look above. We did not adjust anything to our finance charges, meaning that our draft finance charges would be the correct one. And the finance cost given is 49,000. So let's substitute this value. That's 49,000. So we can clearly see that our finance charges is greater than profit from operations, which means that there will be loss for the year. And that is the sum of these two values, which is 19,100 minus 49,000, which results in the negative value of 29,900. All right, this concludes our income statement as well as the second part of this question. And we can see that there was a working section given here. So instead of scribbling our workings in the question paper like I did, you guys should be showing all of the workings for your distribution costs, administrative expenses in this particular box. Now for the third part of this question, explain how your treatment of item 8 would be different if there was a 25% possibility of the company losing the case. Okay, let's have a look at our information 8. This related to our legal action where 75% possibility was given, due to which we termed it as a provision which lowers the profit and increases the current liabilities. But if it were to be 25%, then that would definitely be less than 50%, which would make it a contingent liability, which would only be recorded by a note to the accounts. So we just have to write this all as our answer to the third part of this question. Let's do that. Okay, with the probability of more than 50%, at present, because we were given the probability of 75%. This requires a provision which lowers profit, as we have to term it as an expense, and increases current liability since we have not yet paid this amount. But now we are asked for the treatment if there was a 25% possibility. So if the probability was less than 50%, it would be a contingent liability which would be recorded by a note to the accounts. Alright, this concluded the third part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.